Welcome, this is Lab 3, question 4, and we are preparing a statement of changes in equity. And we have a bunch of information from the adjusted trial balance of a company called Northco in my demo example here. And so the first thing we're supposed to do is calculate the net income or loss for the year. And so we'll do that, and then we're doing a statement of changes in equity. So we'll start with an opening balance, and then we'll make some adjustments and fill out the entire statement of changes in equity, see how we do. And then we'll calculate the tax amount for the correction of the prior period error for depreciation expenses. So that's the item listed here, depreciation expense, 2014 expense understated due to error for $14,000. So that should be fairly straightforward. It should be 14,000 times the tax rate. And then we need to calculate the price earnings ratio. And the price earnings ratio is the ratio of the price per share, which is listed here as 31.62, divided by the earnings per share, which we'll have to calculate. So that's where we're going. The first one, calculating net income. There's a lot of information in one little calculation here. So let me see if I can get it all onto the screen for you. We need to basically, I'll start with, we'll have the revenues there, and then we'll subtract the expenses, and we'll include in the revenues the gains, and we'll include in the expenses any losses. Of course, then we have to put brackets around it so that we can calculate the after-tax amount. So we're going to multiply by 1 minus the tax rate, which is 20%. Okay, so let's get started. Reading just from the top. We have a bunch of expenses, and we'll get to the sales in a bit. So let's just start. We record advertising expense of $45,000. Excuse me. And then we have, well, these first three items, of course, are all, well, these first two items are balance sheet accounts, the contra account for the assets. Then we've got accumulated other comprehensive income, which of course is not part of net income. It follows after net income. Then we have advertising expense, the allowance for doubtful accounts, balance sheet again, common shares, balance sheet, cost of goods sold. There we go, that's an expense. So let's add that in, $984,000. All right, and there are more expenses. Depreciation expense from 2014, which is understated due to an error. We need to adjust that in the statement of changes in equity because it's a prior period correction, as they noted in the question part C. And then we have depreciation expense on the equipment, which is another expense, and depreciation expense on the store furniture. Oops, make that a 0. Whoops, and continuing on, dividends are not expenses. Entertainment expense is an expense, so we'll include that. Freight out is an expense. Freight in, of course, is part of cost of goods sold, part of the inventory cost. But freight out is an expense. Gain on disposal, we are going to include that with the revenue calculation. Or you could include it in its own little bracketed piece. Gain on disposal would be part of net income, and gain on sale of land would be part of net income. We also have insurance expense. So continuing on with our recording of the expenses. Interest expense, we're just calculating net income. We're not actually producing it. We're not actually producing an income statement, so we don't need to worry about EBIT and all those other niceties. We're just calculating the income. Preferred shares, balance sheet, retained earnings, balance sheet. Salaries expense, we'll include that. Sales is part of the revenue calculation, as is sales discounts and sales returns and allowances, but not sales commissions expense. That's an expense, so we need to add that in. And supplies expense, and telephone and intranet expense, and the unrealized gain on the AFS, available for sale investments through other comprehensive income, is not part of net income. All right, so now let's go back to the beginning. So I'll hit the home key, and in this first bracket here, this first parenthesis, we're going to include the sales, 2.4 million. That's a lot of zeros. And then we're going to subtract the discounts, the sales discounts. And we're going to subtract the sales returns and allowances. That's a lot of sales returns and allowances. And then we're going to add the gain on disposal, which is 40,000. And we're going to add the gain on sale of land. Okay. And if we go to the end now, we see we already have the tax included. So that works out to 834,000. And that is our net income number. So we move down to the statement of changes in equity. We need to start with the opening balance. So if we click on here, balance November 1st. So our year end is October the 31st, which is the day before November the 1st. You might want to put the balance of October the 31st down at the bottom, depending on how you want to do that. So we have a bunch of information about the shares in this paragraph, additional income paragraph. On October the 31st, 2015, the number of common shares outstanding was 126,000, and there were no changes to common shares during the fiscal period or fiscal year. So that means that the opening and closing common shares would be the same number. So we can go up here and find it. Common shares, 452,000. So we'll put in 452,000 in the common shares column and enter that, and then we'll just drag it down to the bottom because it says there's no changes. The ending balance of preferred shares is 68,500, which includes issuing 1,700 preferred shares at $5 per share in the current year. So we are going to need to make some adjustments for that. So 68,500, it says, is the preferred share balance. And we can see that in the adjusted trial balance here. And we know that somewhere down here we're going to have to add the preferred shares. And we, of course, we have a couple of items here that are, we're going to include the retained earnings prior period adjustment here. So let's see if we can find that. Maybe under equity, shareholders equity. Headings and totals, revenues, other maybe. No, that's not going to help. Okay, let's see if we can find something here about the, there we go, correction of error for depreciation expense net of tax. And that's going to be right here. And it's going to be 14,000 times 1 minus 0.2. And let me see, understated due to error. So if the depreciation was understated, that means that we should increase the amount of depreciation expense, which should reduce the amount of our retained earnings. So we should go back here and make it negative. All right, and then we're going to have the balance for the retained earnings as restated, beginning balance as restated. All right, so we're going to have to figure out the opening retained earnings number. If we look at the retained earnings up here, we have 155,000. So let's put that in here, 155,000. And of course, there are more adjustments, so we'll just adjust for those as we get there. Now, we were doing all of that so that we have room for the preferred shares. So we have preferred shares here. So let me see. We have just the balance in preferred shares, headings and totals, issuance of preferred shares. That's the one we want. And so we issued 1,700 at $5 per share. So that must mean we have 68,500 minus the 1,700 at $5 per share. And common shares, okay, let's go 155,000 minus 11,200. All right, our accumulated other comprehensive income, we have the balance shown here is 161,000, and of course this unrealized gain through other comprehensive income would have to be included there. So let's take the 161,000 as the opening number, and of course we're going to drag that down to here. All right. So I think the next thing we should do then would be the retained earnings, the net income. So we're going to add net income. There we go, net income. And the amount of the income that we calculated here was 834,000. Okay, then we paid some dividends. And, whoops, that's not what I want there. I want something about dividends. So let's try just searching for dividends. There we go, we have some dividends on the common shares. Then we have some more dividends on the preferred shares. The balances for those dividends are shown here. Dividends declared on common shares 23, dividends declared on preferred shares 53. Let's put those in here, and I suspect we should put them in as negative numbers. Oh, now I'm not sure if I'm remembering them correctly, whether the preferred shares is 53, dividends declared on common shares is 23. Yeah, that looks right. Okay. Now we have the unrealized gain on available for sale investments, and so that's this amount is 36,000. Of course, it should be shown net of tax. So if we click on here and type in unrealized, there we have what we're looking for. We're going to go over here. It's going to be 36,000. Once again, times 1 minus 0.2, and that's an unrealized gain, so we're going to add it. I think that takes care of all of the pieces we're looking for, and so now we have a little math to do. So 143,800, let's just add all of this up. Let me pause, and I'll just add up the numbers. All right, we're back. Now I've just added up all the numbers down to the bottom, and then I've added up the numbers across to make sure they work. So let me drag this one over. That's just simply the total of the 4 items, and then this is the total, that same total, subtracting the 11,200, which is the correction of error for depreciation, and then just drag each one of the across. What I like to do is I want to check to make sure that the sum across is equal to the sum down the side, and so if I drag that over here, you can see that it's the total across the bottom. It works out to 1,612,100, and then I do the same for the right-hand column, the total equity column, and I get the same amount. Of course, I don't want to leave that in there, but it's a good idea to check, I think. So let's just clear that out. All right, now we need to calculate the tax amount for the correction of the prior period error for depreciation expense, and that was the 14,000 times 1 minus 0.2. Well, we don't want the 1 minus, we just want the 0.2 part because it's just the tax portion, right? 2,800. And so let's just quickly check. Depreciation expense understated due to error 14,000. The tax amount is 20% of that. And then it says calculate the price earnings ratio. And so the price earnings ratio is the relationship between the market value for the common shares, so $31.62 is that portion. But the trickier part is calculating the earnings per share. And so we need to calculate earnings per share by taking the income. So let's first of all calculate the earnings per share. 834,000 minus the preferred share dividends of 53,000. Put brackets around that. And we divide that by the total number of common shares, 126,000. We can see right up at the top, just barely inside the screen. 126,000 is the number of shares, and there weren't any added during the period, so we don't have to worry about calculating weighted average or anything like that. So $6.20 is our earnings per share number. Now we want to take that ratio between that number and the price. So I need to put it all into a bracket, all into a set of parentheses, and so we want to divide the price by the earnings, price earnings ratio, price divided by earnings. So the price is 31.62, and so our ratio, the price earnings ratio, is $5, or 5.1 times. So for every dollar of earnings, the market is willing to pay us $5.10. That looks to be all of the information that we need to add. So let's check to see what Lyrics thinks of all of this. Lyric seems to be happy with it. And we've earned all the marks, so we're done.